The US government just showed their cards. For the last 3 days straight, investors have been glued to the COMEX ticker, watching silver bounce around $90. They've been poring over charts, stressing about drops, and wondering if this bull run is done. But while everyone was distracted by what's happening on their screens, the US Mint, the government agency that handles our nation's coins, quietly changed their pricing behind the scenes. And the number they posted isn't just a price bump, it's them admitting the truth. We've got confirmation that the US Mint has set the proof American Silver Eagle at 173. They've put the uncirculated bullion version at 169. Let that sink in for a second. The spot price on your screen says $90. The government's price says 173. That's almost 100% premium. This is the government letting it slip. It's the moment when the people who print the money are admitting that the money is broken. Now, skeptics will say, but the mint is closed. Sales are paused. This price means nothing. I'm here to tell you it means more than anything else happening in the market right now. Why would a government agency that's currently refusing to sell coins because of pricing issues go into their system and basically double the price? They're doing it because they're preparing for what's coming. They know that when they finally open back up for sales, whether that's next week or next month, they can't sell silver at $90. If they did, they'd get cleaned out. They'd be selling a critical asset for nothing by setting the price at $173. The US Mint is telling us where they believe the real price actually sits. They're saying that the paper price of $90 is fake. It's a futures market illusion that has nothing to do with the cost of actual physical metal. This creates two different worlds. In World 1, you've got paper traders on Wall Street swapping digital contracts back and forth pretending silver is worth $90. In World 2, you've got physical owners, the mint, the dealers, the industrial buyers who know that if you actually want to hold the metal, you have to pay double. This gap is what a broken market looks like. When the spread between paper price and physical price hits $80, the exchange isn't finding price anymore. It's revealing insolvency. Think about what this does psychologically. If you're a retail investor and you see the government pricing silver at $173, are you going to sell what you own for $90? Hell no, you're holding. You're going to wait it out. You'll realize that what you have is worth way more than the banks want to pay you for it. This destroys the liquidity for short sellers. The banks need you to sell so they can cover their bets. But the US Mint just told every silver owner in America to hold tight. They've unintentionally created the ultimate diamond hand situation. And look at the timing here. This repricing happened on a Friday afternoon right after a huge attempt to smash the paper price failed. The banks tried to drive silver down to $86. They failed. The market closed the week above $90, the first weekly close above $90 ever. And in response, the Mint raised their price to $173. This is war between the deflationary pressure of the paper market and the inflationary reality of the physical world. The paper market wants lower prices to protect the dollar. The physical market demands higher prices to justify production. The US Mint has picked a side by pricing at 173. They've aligned with the inflation camp. They're admitting that the dollar's purchasing power has collapsed to where a 1-O's coin costs almost 200 units of currency. This is what a currency crisis looks like in real time. It isn't a sudden crash to zero. It's a series of repricings where the cost of real stuff jumps overnight to reflect how worthless the money's become. We're living through the great repricing right now. The screen says $90. The Mint says 173s. Which price is real? The price where you can buy a digital contract that might get settled in cash, or the price where you can buy a physical coin you can hold in your hand? The answer is obvious. The physical price is the real price. The paper price is a coupon that's about to expire. But if the Mint's repricing was the signal, what happened in the vaults Friday was the real action. While the Mint was updating their website, the commercial vaults at COMEX were getting raided. We saw one of the largest single-day withdrawals in the history of the exchange. In the next part of this investigation, we're going to look at the Friday night heist. We're going to break down the data showing that over 4 million ounces of silver vanished from COMEX in a single trading session. We're going to explain why the banks crashed the price to $86, not to make money, but to provide cover for this massive withdrawal. They needed to drop the price so they could raid the vault at a discount. The Mint showed us the value. The vault showed us the scarcity, and together they're telling us that the game is over. While the United States Mint was busy updating their website to show a $173 price, a very different operation was happening in the dark corners of the financial system. We've looked at the daily warehouse reports from the CME Group for Friday, January 16th. These reports are usually boring as hell. They usually show small movements of metal in and out of vaults. A few thousand ounces here, a few thousand ounces there. But Friday's report screamed bank run. In one 24-hour period, over 4.2 million ounces of silver were physically pulled from the COMEX vaults. Let me put that in perspective. 4.2 million ounces is roughly 130 metric tons of silver. This isn't some retail investor buying a few coins. This isn't a jewelry maker stocking up for the quarter. This is a fleet of armored trucks. This is a cargo plane. This is a strategic exit. We need to look at exactly which vaults got drained. The data is specific. 1.4 million ounces came out of the Asahi depository. 1.2 million ounces came out of the CNT depository. Another 1.2 million ounces came out of the JP Morgan vault, and nearly 800,000 ounces came out of Manfra, Tordella, and Brooks. This was a coordinated, systematic raid across every major custodian in the COMEX network. And here's the smoking gun. This withdrawal happened on the exact same day that the paper price got smashed to $86. You think that's coincidence? You think it's random that the price dropped $6 right before 4 million ounces left the building? No way. It was a heist. The banks engineered the flash crash to $86 for one specific reason. They needed to settle their physical withdrawal requests at a discount. When you're withdrawing 4 million ounces, a $6 drop in price saves you $24 million. They smashed the price to loot the vault. But the scariest number in the report isn't the total withdrawal. It's the collapse of registered silver. In the COMEX system, registered silver is the metal that's actually available for delivery against futures contracts. It's the inventory with a for sale sign on it. Friday, the registered category plummeted by over 2.5 million ounces. It fell to just 120 million ounces. This is the buffer. This is the safety margin, and it's evaporating. When registered silver drops this fast, it means that the owners of that metal, the banks and the trading houses, are pulling the for sale sign. They're moving the metal into private hands. They're taking it off the market. Why would they do this? Why would they pull inventory right when prices are hitting all-time highs? Because they know what's coming. They know about the Trump proclamation. They know about the Section 232 review. If the United States government is about to declare silver a critical mineral and implement price floors or pulling the collateral, they're caught in a vice. If silver's price rises to $100, the losses on a 4 billion ounce short position would be catastrophic. It would wipe out the bank's equity. It would require a Federal Reserve bailout bigger than 2008. This explains the violence of the price action. This explains why they smashed price to $86 Thursday. They're fighting for their survival, but the retail crowd is relentless. 169 days of buying proves that regular people aren't selling dips. They're buying the dips. Every time the banks smash price, the ETF inflows accelerate. The banks are trying to scare people out, but they're only inviting them in at better prices. This is the unstoppable force meeting the immovable object. The unstoppable force is the inflation-fearing public. The immovable object is the insolvent banking cartel. Something's got to give. And based on the vault data from Part 2, what's giving is the physical inventory. The ETF structure acts as a buffer. It absorbs retail demand and keeps it away from the physical market for a while. The authorized participants can use leasing and accounting tricks to satisfy ETF rules without actually moving metal, but they can't do it forever. Eventually, the gap becomes too big. If SLV says it holds 500 million ounces, but the vaults are empty because the silver went to Shanghai, the ETF implodes. We're approaching the moment where paper claims exceed physical atoms by a ratio that triggers default. For individual investors, this data carries a stark warning. If you're part of that 169-day streak and you're holding SLV, you're sitting in the danger zone. You're holding a receipt for a car that's already been stolen. When the squeeze finally breaks the banks, the ETFs will likely get settled in cash. They'll give you dollars, but you don't want dollars. You want silver. The retail crowd has the right idea. Buy silver, but wrong execution. They're buying the map instead of the territory. This massive inflow of capital proves that sentiment has shifted. The public is awake. They know the dollar is dying. They know inflation is real, and they're voting with their wallets, but they're voting in a rigged ballot box. The Friday night heist we discussed in Part 2 was smart money taking physical metal before ETF holders realize it's gone. So where does this leave us for Monday's open? We have a market where price is $90. The mint is at 173, Shanghai is at $12, and the banks are short 4 billion ounces. This is a powder keg. The retail buying is the fuse, the vault drain is the spark, and the explosion will be the repricing of silver to a level that balances the books. That level isn't $90, it isn't $100. In the final part of this deep dive, we're going to look at the verdict. We're going to combine the mint pricing, the vault drain, and the short position to calculate the real target. We're going to discuss the Monday gap. With all this news breaking over the weekend, the US mint repricing, the vault drain, the market's likely to panic at open, And we're going to give you the final strategy for navigating the great repricing. The banks are trapped, the public is swarming, and the metal is gone. The only way out is up. We've arrived at the conclusion. If you've been with me through this forensic investigation, you now have a picture of the market that mainstream media refuses to show you. You understand the sovereign leak where the U.S. Mint admitted the real price is 173. You understand the Friday night heist where 4.2 million ounces got looted from the vaults. And you understand the retail swarm that's trapped the banks in a 4 billion ounce short position. The evidence is overwhelming. This isn't theory. It's a mathematical disconnect that can't be resolved without a massive repricing event. Today, Saturday, January 17th, 2026, we're staring at the largest pricing anomaly in financial history. Look at the numbers one last time. Spot price on COMEX closed at $90.14. Shanghai price closed at $12. The United States Mint price is effectively $173. The gap between paper price in New York and sovereign price at the U.S. Mint is $83. That isn't a spread. That's a chasm. That's the Grand Canyon of financial risk. If you can buy silver for $90 that the government says is worth $173, you're looking at the trade of a lifetime. You're buying dollars for 50 cents. But this anomaly won't last. Markets hate a vacuum. Physics demands equilibrium. There are only two ways this gap closes. Scenario 1, the U.S. Mint is wrong. The shortage is fake. The 4 million ounces return to the vault and price crashes back to $90. Given the data we've analyzed, the inelastic industrial demand, the depleted mines, the retail hoarding, this scenario is impossible. The metal is gone. It's not coming back. Scenario 2, the paper price on COMEX gaps up to meet physical reality. This is the only path forward. The paper price is a lagging indicator. It's the last thing to move. Physical price leads. Shanghai price confirms and eventually paper price capitulates. We're setting up for a Monday morning shock. While markets are closed this weekend, the news of the U.S. Mint repricing is spreading. The news of the vault drain is spreading. Investors around the world are doing the same math we just did. They're realizing that $90 is a gift. When markets open in Asia Sunday night and in New York Monday morning, we expect to see a rush for liquidity. We expect to see traders trying to front-run the U.S. Mint. If the government thinks silver is worth $173, then $95 is cheap, $100 is cheap, $120 is cheap. This creates a buying panic that overrides the bank's suppression algorithms. So what's the verdict? The verdict is that the great repricing has begun. The era of double-digit silver is effectively over in the real world, even if the screen hasn't caught up yet. The verdict is that banks have lost control of physical inventory, which means they've lost control of price. They can print paper, but they can't print metal. And the verdict is that we're witnessing a wealth transfer from those who trust the screen to those who trust the scale. So what's your strategy? How do you navigate this chaos? Rule number 1, don't sell your physical metal. I know the temptation will be strong. If silver hits $100 next week, you'll feel rich. You'll want to cash out, but remember the U.S. Mint price. If you sell at $100, you're selling at a $73 discount to the government's own valuation. You're getting ripped off. Don't trade your scarce asset for a dying currency. Hold until paper price matches street price. Rule number 2, ignore the volatility. The banks are wounded, but they're not dead. They'll try to smash price again. They might try to drive it down to $88 to trigger stop losses. If you see a red candle Monday, laugh at it. It's a fake signal. It's a paper game. The real game is played in the vault, and the vault is empty. Rule number 3, watch the spread. The most important chart right now isn't silver's price. It's the difference between spot price and physical price. As long as that spread exists, as long as the mint is higher than COMEX, the bull market is intact. The squeeze is active. We're watching the collapse of a 50-year scheme to suppress the price of real money. It's messy, it's volatile, it's terrifying. But it's also the greatest opportunity of our lives. The United States government just tipped its hand. They told you what they think silver is worth. They told you it's worth $173. Believe them. The banks are short, the mint is closed, the vaults are empty, and the price is $90. You know what to do.